Good morning, Rahul. We consider now the next topic as a taxes. Next topic as a taxes. But majorly for engineering economic consider as the four taxes as a income tax, property tax, sale tax, and the excise tax. So these are the four taxes we consider in the engineering economy, and these taxes are income tax. Now, if we consider income tax, so it is based on it is a function of the gross revenue. It is a function of the gross revenue, and to consider the gross revenue, we minus or deduct some allowable deductions. So, gross income or gross revenue we topic, time and money topic. This bracket we already discussed. So these brackets are these are the general notations. These are the general notations in which we are considering that particular rates. We are considering particular rates, and these brackets we can solve by considering that formula of present worth. Considering that formula of that present worth. So to calculating it IRR value, we find out that present worth. We have to find out that present worth, and then equate to the zero. Then equate to the zero, we will get at IRR value. We will get at IRR value. So present worth formula is like this. So minus 250,000 cost basis system plus 40,000, and for this value for the rate of this 40,000 value for the 10 years with rate of 10%, and 30,000 is the market value. It is a market value after some years. So these notations are these are 40,000 per year. So this notation here changes. This is considered as a per year. This is considered after some year, or this is the future worth value. This is the future worth value. This is the annual worth value. This is the future worth value, annual worth value. So for each year we consider this. For after some years we consider this value. So 30,000. So these terms are different. So I already go through this in time value of money topic. So this is the typical formula. So at 10%, by considering 10%, there are some value. Of present worth this much. For 10%, if you consider 10% rate, present worth value is this much. If you consider this 10% rate is replaced by 12% rate, that present worth value now becomes this much. Present worth value becomes this much. Now by interpolation method, for 10%, this present worth value is 7,348 rupees. For 12%, that present worth value is minus 270 rupees. So for ith rate, and for 0th present worth value, so we equal to 0. Present worth value equal to 0. So present worth value 0. What will be the rate of that return rate? For income return rate, what will rate we consider for this 0 present worth? This is we can solve by interpolation method. 10% we have some value, 12% we have some value. For ith percent we have 0 value. So what will be that I percent? So that will be calculated by interpolation. And by interpolation it comes as a 10.67%. So at 10.67%, that present worth becomes as 0. Present worth becomes as 0. This is nothing but IRR value that we asked. Now after tax, these are the IRR value, and they calculate present worth of the cash flow after tax with considering this minimum acceptable return rate as a 10%. So this we can calculate it like this. Minus 250 plus 44,000 for first year, for second year, for third year, for fourth year, for fifth year, sixth year, like that. So this is the amount of the after tax cash flow. These are the amount of the after tax cash flow for fifth year, sixth year, like that. Up to 7th year, 24,000. Up to 7th year, up to 24,000 we consider. Up to 7th year, up to 24,000 we consider. And this present worth calculated like this. At 10%, that present worth after simplification of this, that present worth comes as a 18,268 rupees. 18,268 rupees, that present worth we get. These examples are based on such formulas, present worth formula. So these are some taxes consideration. These are comes under the taxes consideration. So these are some formulas, and last one is the so this is at 10%. At 10% we find out that present worth this much is the value, and for 12% that present worth we get this much of value. So by again interpolation we will get that rate, that income return rate becomes as a 8.128%. So this much of the rate, for the after tax, for before tax and after tax. These calculations are repeated for before tax cash flow and for after tax cash flow. And again third term is asking at a minimum acceptable return rate that present worth becomes like this, as calculated in step B. As we calculated in step B, that present worth comes as a like this, 18,268. These examples based on the taxes.